Hi, my name's Trey Reik of Bristol Gold Group, and we're here with Brett Rentmeester of Windrock. And we both had the opportunity over the weekend to watch a fairly long interview with Tucker Carlson and our Treasury Secretary Scott Bessent. And we'd like to show you a clip of that hour-long interview and then discuss it a little bit after.
There are a lot of different stores of value over time. Bitcoin's becoming a store of value. Gold has historically been a store of value. I think what's interesting is, where do we see the gold demand coming from? A huge amount is from China.
Yes.
Where, as I said, they're in the middle of an economic recession/depression. People don't trust the Chinese currency because they have capital controls. There are 1.4 billion Chinese who all want to get their money out, and they won't let them. They will let them buy gold.
So that's the response, you think. But it's just, do you find it interesting that even now, 2025, when everything is abstract and digital, that gold is still widely believed globally to be a reliable store of value?
I think that gold has a lot of history going with it.
Yeah.
That a friend of mine's grandmother, during Russia had a financial crisis in '98, then they had a big inflation, and a friend of mine's grandmother went out and bought 18 bicycles and put them in her apartment, and that was her store of value.
Yes. So how'd she do on the bike investment?
Great. I wish I did that well. But that, look, gold also has other applications, a lot of applications, jewelry in India, but it's something that historically people have all agreed on. And gold can't have a fiscal problem. Gold cannot have a gigantic budget deficit. Gold cannot have a war. So just the fact that it is this isolated thing makes it very interesting. And the fact that the entire global trading system, until Richard Nixon took us off, was tied to gold.
So you're not anti-gold?
Oh, no. When I had my fund, I think people might have called me a gold bug.
So, Brett, you and I are fairly similar, I think, in our interpretation of gold's role in a portfolio, in both a diversification sense and getting a little money out of the financial system and dangers that may be related. Were you surprised to hear the U.S. Treasury Secretary be as supportive of gold as he was in that clip?
Yeah, I think it's a new chapter, right? Prior administrations would have discussed it as a pet rock and all these other things. So I think it's an acknowledgement and maybe a warming the public up to the idea that we need to think about assets on the U.S. balance sheet and how they play a role in supporting the dollar or other things, and gold is certainly one of them.
Mm-hmm. So one of the interesting things I thought about the interview was Tucker seemed to be relatively surprised that the U.S. Treasury Secretary was being complimentary about gold's investment qualities. What'd you make of that?
Yeah, I think he was surprised. Well, I think historically, gold has kind of been the enemy of the dollar, right? Because it's a place people could go that wasn't dollar denominated. And, as we know, in a world where bank reserves are minimal, holding up all this lending, if all of a sudden everybody pulled 5 or 10% of their money and put it in gold, the whole banking system kind of ceases to operate. So I think in the past, gold has always been public enemy number one. Mm-hmm. And the idea that they're talking about it and discussing the merits of it does tell me there's maybe something going on, a warming up to this idea that we have to not treat gold and other assets as enemies, but maybe view them as strategic assets that we own on the balance sheet.
Mm-hmm. Scott Bessent has talked about monetizing, America's assets. And that has led in gold circles to a certain amount of speculation that what he's talking about is revaluing the gold on the Treasury and Fed's balance sheet, which is currently valued at $44. And if you revalued that to current market prices, you're talking about, 800 billion, something like that. And if they did that, theoretically, they could repo that with the Fed, and the Treasury might have to issue $800-900 billion less of treasuries this year, in a year where I think they have 11 trillion they need to roll. So do you give much credence to that, or do you think that's contributing to gold's strength?
I really don't give too much credence to it or think it's contributing too much. And part of the reason is it's a known thing.
Mm-hmm.
I mean, we know it's being held undervalued. We don't really know that we have it all. I mean, that is
right.
It's the bigger question. But assuming we do, people have known we're carrying it at below what it's worth. Does that really move the needle? It seems like it's positive, but it doesn't seemingly move the needle. I think to move the needle, it would really have to be more of a strategic building of gold and silver on the balance sheet and letting the value, rise accordingly. And then maybe at a much higher value, there's a story to tell and a kind of a way out of all the Treasury issuance.
With respect to gold's recent strength in the past 3 to 6 months, there's been a lot of attention paid to central bank buying. And I think that's an important component in stabilizing the gold price. But central banks don't generally buy in upticks, and this has been a pretty aggressive market. So what do you attribute gold's recent strength? I assume you would agree with me that it's been a bit surprising.
Yeah, well, I think it might be that it's more common knowledge now, the predicament that most global economies are in relative to debt levels and just the unsustainability of the path.
Mm-hmm.
It's something we've been talking about since we founded our firm, post the 2008 crisis. But the reality is we've gotten into such a habit, especially in the Western economies, of just printing money and kicking the can, and everybody feels good with stimulus, that a lot of people haven't slowed down to really look at what's going on under the hood. And I think the numbers are so big and so staggering now that more and more people are waking up to the fact that we can't keep spending at these levels and printing money like we are, and there's a real risk ahead. And I'm not just talking about the US. This would apply to Europe, Japan, China, modern economies, that they ask the question, okay, if something failed, if currencies went bad, where can I hide out? And they start going through different areas. And, one of the few areas where you have no counterparty risk, no real leverage, it's an asset you can own directly, are things like precious metals, gold
Mm-hmm.
and silver. So I think there's just more of an acknowledgement of that. And then to your point, I think central banks, with the Basel III rules coming into play, gold can play a more prominent role on their balance sheets. And I think we're going to see that as well.
You're talking about Basel III now?
Yes.
Yeah, and that's coming in June. We've been reading about that for a good 7 or 8 years, but apparently it's finally going to happen.
That's right.
Yeah. So do you at Windrock have a methodology for what you think gold is worth?
Yeah, I mean, we use some other people's methodology generally. And listen, there's upside methodology, like the famous Jim Sinclair, where you kind of figure out the amount of money in the system, and you figure out if you backed reserves at a certain level, what kind of numbers you could get. And clearly in some distressed world where there's truly a currency issue, those numbers are very high, right?
Mm-hmm.
Tens of thousands of dollars or higher. But more realistically, I think it's kind of like a Bitcoin or some of these other assets. The value is hard to ascertain and project, but it seems like if you use a little bit of that thinking of money printed and out there in the system, that you could justify much higher levels than we're even at today at the $3,000 mark. Doesn't mean it will be a straight march there, but the idea that gold could be $5,000 to $15,000 in the next 3 to 5 years
Mm-hmm.
is kind of a range that we think is very reasonable, depending on what transpires.
And what would be your response to investors who think, as usually happens whenever gold starts going up, that they missed it? We're starting to hear that a little bit more frequently. Gold's one of those funny assets. If it's going up, people feel they missed it. If it's going down, they say, I told you so. And if it's not moving, there's no urgency. So there's never in investor's mind, because of that familiarity with the asset class, there's always a reason not to buy it. And the current reason is, I missed it. It's up too much. What will keep gold going in the next year or two, you think?
Yeah, I mean, clearly not investment advice, but just general thinking. I think that's always how people feel when any asset moves up. And you're right, it seems to be magnified in gold and silver. And quite honestly, it is harder to buy today than it was a year ago and 3 years ago. I think the mindset is you should have a core position and at minimum kind of dollar cost average in. And honestly, we're migrating a little more towards silver in the equation, given the big gap between gold and silver. People have different views on that, but the ratio of the two is near an extreme. So in times like this, we may overweight the asset that's underperformed on the theory that over time, these ratios come a little back into historical alignment. So that's another way to do it, is to try to look for the areas that are a little more undervalued relative to historical norms. And then coming up with a plan. And maybe not doing it all today if you're brand new, but getting a core amount that matters and building on it.
Last week, gold was down about 1.5% and silver was down 13.3. So as you point out, the gold to silver ratio at one point this morning was at 102, which is very, very high. So are you suggesting, as I think you are, that it makes a lot of sense to take a look at the silver side here, because that's very likely to balance out at a lower ratio in the near future?
Yeah, I think so. I mean, I don't know when the ratio will correct, but we're general believers in reversion to averages and ratios that make sense. And I think, Trey, you'd be better than me to say, but I think it comes out of the ground at about 15-1, plus or minus. And silver gets depleted. I think silver gets hit because people think of it as also an industrial use. So if there's fear of recession, it gets pulled down. But the reality is all the gold that's ever been mined is pretty much out there. That's not true for silver. So I think, again, not investment advice, talk to your own advisors, but silver is probably one of the cheapest assets given the environment we're in out there. And it really hasn't kept up with gold, but I would not be surprised if it played catch up in the years ahead.
At Windrock, do gold equities play a part in your approach to portfolios?
Yes, they do. I mean, in addition to physical gold and silver, we do like some of the mining companies. We use some actively managed strategies. And obviously, in periods like this where gold's gone up a lot and mining costs are somewhat contained with what's now lower oil, et cetera, the margins of those companies should be reflective of some great gains.
Are you comfortable mentioning a name or two?
Well, I mean, we generally do it with, we generally invest with a diversified portfolio where we're not the ones, we're hiring an investment manager to pick the name. So I'd rather not speculate on an individual name. But I think we stray away from the really speculative stuff at the bottom, trying to find mines and et cetera. And so it's kind of the middle of the market up to the big companies. And we rely on an active manager that's very deep in the space, to make those specific judgments.
Great.
We focus more on just having an allocation there and believing in the space.
So I have this theory called the negative survivorship bias, and that'll be the last question I'll pose on gold stocks. But gold mining is one of the only industries in the world where you're not necessarily best suited to pick the largest participants, right? Because it's so hard for Barrick and Newmont to replace their reserves. So I assume what you were sort of agreeing with that and saying it's the middle part of the structure where the greatest opportunities lie.
That's probably accurate. Yeah, I think that's an accurate statement.
Terrific. So with respect, I don't think any conversation can conclude without a little bit of mention of tariffs. So we've had a pretty tumultuous week. We're 2.5 months into President Trump's second term. Do you think, how's this whole tariff thing going to play out, do you think? Is it inflationary? Is it supportive of the dollar? What are you guys expecting over the next, 9 to 12 months?
Yeah. Well, I think, maybe starting at the top, I think people have been surprised by the strategy of just kind of coming out against every country and it not being reciprocal. I think most people expected this to be a negotiation, a grand negotiation, and maybe are supportive of that, hey, if you're charging me tariffs and I'm charging you, maybe we'll threaten each other and then actually sit down and we'll end up with no tariffs, more of a free market solution. I think that's what most people hope for. On the other side, if a country's not going to let go of a tariff and they're going to charge 20% on everything, then the idea of a reciprocal tariff seems somewhat reasonable. You're going to charge 20%, we'll charge 20%. I think what's gotten the market a little unglued is it hasn't really been this exact reciprocal thing. There's a lot of other math and fuzzy things in the gray zone that seem more like a blunt kind of negotiation tactic. So I think we're still hopeful that this is a grand negotiation, and in a couple months we come out the other side and are feeling good about it. I think the problem is we're in an over-levered global economy.
Right.
We have some of the highest equity U.S. valuations ever. And, any pinprick in this bloated balloon could be, a mortal wound. So does this trigger, I was with a business owner recently and they get everything from Vietnam and they've got 35% margins. So their margins disappeared overnight on paper. And so do we get businesses to freeze up and not make any decisions? And then, we lead to a recession. So I think the longer this goes on, the more risk for collateral damage. And that combined with a massively overvalued U.S. stock market is a dangerous backdrop. On the other hand, maybe those things won't fall apart and they'll be able to kind of hobble through this, get enough big wins along the way. I think China will be the difficult piece. I think a lot of other countries, it seems like they will come to an agreeable point. But so I think volatility remains high, and really we're in this critical window, the next 2 months, let's call it, to see how we navigate it. I'd say we're still hopeful that it's more of a negotiating tactic and we get, in a lot better spot here in a couple months or shorter. But there's a very real risk that this spills over if there's any unforeseen hiccups.
Would it be fair to say that Windrock portfolios are defensive, or have you made any changes, or how are you playing this?
Yeah, I'd say we came into this period very defensive. Part of it is because we believe in kind of reading the macroeconomic indicators. Of course, there's a million of them. You can make a lot of mistakes. But two things jumped out to us in the fall of 2024 that have made us much more defensive into this period, even though it seemed early back then. One was the long-standing inverted yield curve where short rates were higher than long rates. And then the re-acceleration of a vertical curve. A lot of times that's been an indication that weakness lies ahead with a little bit of a lag. The second is U.S. money supply growth had contracted and is still kind of at low levels of growth. That's another factor because we are believers that this market runs on liquidity more than anything. So we came into this period defensive. We fully intend to be more aggressive. I think it's a little premature. I mean, it's great to think, hey, particular stock's 30% off its highs. What a bargain. But the reality is some of these, you look back, they're not even, they were higher than that a year ago. So if you weren't buying them a year ago, is it that tempting to buy them right now? I'm not sure. I think we're waiting to see if there's more carnage. And I can tell you in prior periods where things fell dramatically, like COVID, we were very aggressive buyers and loaded up on a lot of energy, which we hadn't owned prior to that. So I think a best case scenario would be we get another bite at the apple on really discounted assets. And right now you're starting to see some, but again, the risks to the downside or that we trigger some collateral damage are very real too. So I think it's a little bit of a wait and see mode right now.
Sounds to me like your thinking is very similar to Mr. Prince at Bridgewater, who I read an essay that he wrote very recently, and he mentioned that one of the worst things you could do, one of the worst sort of panic moves you can make is to raise too much cash in times like this, and that it's much better to prepare for a range of outcomes and have a portfolio that can perform well under a range of outcomes. Is that sort of the approach that you're taking?
Yeah, I think like any advisors, there's going to be diversification across asset classes, and that's going to be true. I think where we differ is compared to at least the industry, is still very reliant on the stock and bond market, and maybe hedge funds as their core components. We have a lot in hard assets, a lot more than average, and we also have a lot of unique private investments we get involved with. So we have, quite honestly, less reliance on whether the U.S. stock market is up or down. Doesn't mean it doesn't impact us, but a lot less reliance than the average investor. And the bond market to us has been a placeholder for cash, and we generally are rolling short-term treasuries. We're not we're not finding the bond market overly attractive on a long-term basis. It serves a role, certainly in the near term, as a place to preserve capital and earn a little bit while you wait and find other opportunities. But I'd say that's our level of how we think about diversification.
Excellent. Well, in these tumultuous and exciting times, if viewers would like to contact you to review their portfolios and talk about services that Windrock offers, what's the best way for folks who are interested in learning about Windrock to get in touch with you?
Yeah, I think the best way is our website, windrockwealth.com. It has all our contact information, but also has a whole library of research, including interviews and articles we've done, including a number of them on gold and other assets. So I think that's a good place to start.
Excellent. Brett, thanks for your time, and best of luck for the rest of the year.
Okay, you as well. Take care.
Bye-bye.